Hey, I'm Connie from Prosperity Finance, sharing the best financial tips so that you can be more successful with achieving your financial goals. Today, I'm really fortunate to invite a accounting firm partner. Her name is Yiping. Yiping is a partner for Gilligan Sheppard. She has been working in the firm for more than 16 years. She has vast experience. In today's video, I'm going to invite her to discuss about ownership structure. And we talk about why it's so important and what are the options available to own assets. So firstly, let's welcome Yiping. Hello, Yiping. Welcome to our program. Thank you for your time today, Yiping. Firstly, can you please give us an idea what's your business at Gilligan Sheppard? What kind of a service do you offering?
Thanks, Connie, and thanks everyone for watching. So I'm Yiping, and our firm is Gilligan Sheppard. So Gilligan Sheppard is an accounting firm, traditional accounting firm, based in Queen Street, and we've been there for 30 years. I have two other partners, Bruce Sheppard and Richard Ashby. Bruce is sort of a finance guru and Richard tax guru. So together we have a team of 30, around 30 in Auckland, and we also have some outsource based team based in India and the Philippines. So altogether we have about maybe 50. Our traditional business is accounting firm, so we prepare financial reports, we give a basic business advisory, and we look after the tax. But our firm has been involved in land transaction for way back to late 80s maybe, so we have established quite good expertise in that land transaction area, and from there we developed a full service VAS team. We've got a value-added business. So VAS team is basically all the service, financial service you will need surrounding a transaction. So transaction could be a property purchase and a sale, could be business purchase and a sale, could be a divorce, and how to split the matrimonial property. So there will be heaps of transactions, and we developed our service surrounding transactions. So that's the VAS team, what we do, yeah.
Great, thank you, Yiping. It's actually, quite a variety of services you're providing compared to kind of a traditional accounting firm just preparing financial accounts. We've been asked a lot by our clients in terms of, what is the ownership structure to own their family home or rental property, etc. Now, normally, we refer these clients to accountants, but sometimes they don't really get good advice. I guess the biggest question people have is, firstly, why we need to consider ownership structure? Why is it important?
When individual or family start purchase a big chunk of land, so that's actually a quite major transaction for all the families and individuals, to be honest. So in the process, you converting the cash reserve you've got to a piece of fixed assets, and that assets could be your family home that you're going to live, or could be an income deriving investment. In the process, you also engage significant amount of debt. So basically, you combine your cash reserve and the ability you can borrow into a piece of fixed assets. So in the process, the cash can be held by someone, but it's usually sitting in someone's bank account, right? It's quite fluid. But the fixed asset needs a name, needs an ownership structure that to hold the fixed asset. So this is quite a serious sort of matter you need to consider. If you do not consider well, then sometimes you change the ownership of the wealth, because the cash could be held by the Mr. and Mrs., but the fixed asset under a kid's name. So if you do not have a loan agreement or whatever, accidentally you convert the wealth to to a kids, you know. So you need to be really careful when consider that. The other factor here is there's always tax issues you need to consider. Different structure give you different tax benefit. So tax is something huge expenditure in your investing activity. So you need to make sure you plan that well to derive the best yield from an investment. The other thing is the asset protection. So we all conduct different business activity or under our own name, and we enter into a relationship with someone. So sometimes the asset under our name may subject to claim of our business creditor or maybe our matrimony relationship, the other party. So you need to understand what kind of risk you put into expose the asset to if you put that into a structure. So that's really important. So, and sometimes, to be honest, these types of structures you can use, but you have compulsory condition that you can't use some structure. So, for example, you've got the law you need to comply with, the OIO law or Overseas Investment
Act.
Act. So they restrict an overseas person purchasing an asset, which means that person could not legally own the asset. So the ownership structure were excluding that individual's name or whatever structure you may build surrounding that name. So sometimes you have to structure against some legislation. And in recent years, there's so many international cooperating to collect the tax. So there will be common reporting standard, there will be anti-money laundering client due diligence that prevent you from showing your name there, or all kinds of reasons that affect the ownership structure selection.
Okay, great, Yiping. Okay, can you give us some advice in terms of when we should consider about ownership structure? Sometimes I get asked by clients that they want to just settle the property first and take time to consider all the options, and if necessary, then they transfer the ownership later. What are the disadvantages of doing that way?
So the most disadvantage, the most obvious disadvantage is the cost associated with that transaction. So you borrow against the structure one, ownership structure one, and then the ownership is, so you want to transfer to the other structure, then you need to consider you at least you need to in the bank you need to change whoever is a borrower, so that could be significant cost. And then you need to transfer title, so there will be legal fees involved as well. So that's very obvious, but the hidden cost is the tax. So now we have IRD has introduced the first obvious hidden tax cost is we have bright line test. So any residential property transfer hands within 2 years and later on 5 years were subjected to tax. At the moment, the property market is flat, so you may not feel much better. In the time that the property market is rising, then you may face a big tax bill every time you transfer from your own name to a trust or to other structure, you know. And the other hidden cost of the tax is IRD do monitor every individual IRD numbers. When they dispose asset, they monitor that, and they want to make sure all the transactions tax implication has been considered. So if you have 3 to 4 rental property and then all of a sudden you transfer all that to your trust, then in IRD's computer data match that will cause alarm, and they will say, oh, someone's doing something and let's go have a look. So that's another risk. So yeah, there's risk associated and cost associated with a transfer ownership structure later.
Right, thank you for the insight. Probably the best idea to get it right the first time. And also, it's really important that, you know, we also, in terms of before going to the bank and request a loan, we need to finalize the ownership structure, because if you have to change before settlement, then the loan proposal also has to be changed, and that might delay the settlement process. So it's really important that before you even think about buying a piece of of assets, best to go to see an accountant or go to see Yiping, her colleague first, and then finalize the ownership structure before you're actually going out and to buy a property. So that's really good advice, Yiping. Finally, Yiping, can you give us some overview in terms of what are the options for ownership structure? By default, we can use our individual name, but what other option available?
So you have individual name, and you have a partnership. So you can have two individual or two company or two trust, or the combination of the entities and to form a partnership. You can have joint venture, so you can have a joint venture agreement to define a joint venture, or you can have incorporated joint venture. You can have a company, and there's look-through company, there's normal company, and you can form limited partnership. That's very, very helpful for overseas person who invest in New Zealand. And obviously you can have trust. So the trust, we have foreign trust, we have New Zealand compliant trust. And if to form a trust, you need to consider carefully who will be those different parties in the trust. I think that's about those are the common structure, ownership structure we use in New Zealand, and even globally it's quite similar.
Oh, good. It's really good that you have a lot of options. I guess for people who has no kind of accounting backgrounds, it can be quite overwhelming. So we'll probably need another session just to go through in kind of more detail. And we will have Yiping's contact details in the video below, so you can contact her directly. Thank you so much, Yiping. It's really good to give us some kind of a background in terms of ownership structure, why it's important, and what are the options available. If you like this video, please feel free to share with your family and friends, and please don't forget to subscribe our YouTube channel. Thank you so much. I will see you next time. See you, Yiping. Bye-bye.
Thanks, Connie. Bye.
Bye.